Good morning,
Morning.
beautiful people of the internet, and welcome once more to our Sunday special live chat. Joined, not as always, but as we like it, with Safe Jersey when he can. Welcome, Safe. Mr. Rusinek, Piotr's with us. And Adam G. Lawrence is in the house. That's what we like to see. Um, in case you don't follow us on all social medias or know exactly what all of us do, you have Proponomics here with Adam Lawrence, and you have Property Auction Hunters, which is an endeavor myself, Piotr, Safe, and Omar do, where we assess auction deals online, tear them to pieces, say what we would and wouldn't do about them. So, before we get too heavily into this, I this morning had a lay in, so I've not read Adam's property supplement. I've not done it, Adam. I'm being honest right up front. It's not happened, but it's a very rare Sunday lay-in for me, so I'm not too upset. So, will you give me, at the very least, a quick run through of what you put out there?
I think honesty is the best policy, and that definitely applies with the supplements. You don't really want to blag it because it could have been about anything. Let's face it. But um, whereas it's that chunky week of the month where, apart from anything else, inflation figures are out, unemployment figures are out. It's a big one because a lot of people were waiting on stuff that was never really going to happen, that then didn't happen, perhaps unsurprisingly, which included inflation ticking back up a little bit. Rather than the forecast, which was for it to tick back down. So that doesn't help to allay fears and, all these rate cuts that people have been theorising. The current sensible thinking would be they're going to take a bit longer than expected, and not expecting the first one until Q2/Q3, sort of middle of the year, basically, is where I've been at and is where I'm still at, primarily because I don't really make my decisions based on something that happens over one metric or one measurement or 1 month or 1 day, like a lot of the rest of the world seems to do for whatever reason. So inflation, is it licked or is it going to be stubborn around the 4% mark, which has been my contention for a while? It looks more like the latter at the moment, although we're going to see some drop-offs because, apart from anything else, the current best guess for April's utility bill adjustment, when the price cap rolls over again in April, is that they'll go down 14%, which will be very good news for people and is much more normalized than probably brings electricity and gas domestic prices into line with real terms inflation. So the rough figure to remember is about 25% COVID premium, which is kind of the figure, cleverly enough, that seems to be encompassing house prices, wages, prices of everything else in general, and energy is going to fall back into line with that. And because the way the inflation figures work, that means the percentages will come down. But I always make the argument we're watching the wrong thing and we talk about the wrong stuff. CPI is great because it gets all the headlines, but really what we should be watching is core inflation. Core's still 5.1. And then the last 6 months core, there's a good argument for using the last 3 months or 4 months or 6 months to come up with an annualized figure. If you use the last 6 months worth, then core inflation is 3.03% at the moment, which feels a little bit closer. I think my range for the year is sort of 3 to 4% to be trading between, although we have to remember these base effects that I tend to mention from time and again. So because prices, especially utility prices, were so crazy last April, but of course we had the price cap protecting us at the time in terms of the government subsidy side of things, which of course got phased out very quickly, then the figures might look better than they are. But the thing that goes along with all of this is wage inflation still at 6.5, 6.6%, depending which measure you use, which is obviously fairly significant and ahead of inflation, which is a good thing because households are putting real money back in their pockets after having real money taken out of them for a fairly sustained period after the free money in the pandemic kind of dried up a bit and everybody got a bit more sensible again. So wage growth still smashing forward, really, but calming down a bit. Services inflation, which nobody else seems to talk about for a reason I can never understand, still at 6.4%. So you can tell these aren't numbers that are congruent with the 2% target at the moment. And I wouldn't worry too much about the next few months worth because some pretty big base effects are dropping off. But we could easily see, for example, in April, inflation touch something in the twos, maybe something like that. If anybody declared the war on inflation over at that point, that would be foolish because we've got that big base effect specifically kicking in April. And in May, we'll find out what everybody does with their new higher pay rises, if they're on minimum wage or something that is slightly attached to minimum wage, or their extra pension money, or whatever you want to call it. We'll see. So jury's still out. Rick's house price balance was another one. That's not a guy called Rick who talks about house prices. That's the RICS. I mean, of course. There was a lot of positivity around the fact it printed -30, which seems a bit crazy, but that was the best print for over a year. So a rough guide. It means 2 surveyors think things are going down for every 1 surveyor thinks that things are going up. But we've been much, much more negative over previous months. And that balance is from December, and that was before the rate cuts in January. So I'm expecting a pretty good print on the Rick's house price balance next month. That is hopefully something for all of us there on that one.
Can I just ask you a quick question as well, just with regards to you're talking about gilt and stuff? I noticed something this week. I don't know whether it means anything or not, but I noticed that the gilt was actually slightly higher than the 5-year SONIA swap rate. And normally there's obviously a spread where obviously the SONIA swap rate is obviously higher than the gilt. What does that mean, if anything?
You haven't read the supplement either, have you? Because I've said exactly this in paragraph 32. Okay. I've got you safe, Jersey, right on live on camera. Right, no, it's a great question, and it's a very, very valid question because I actually go into a bit more detail about this. And the reason why I do is when you, at the turn of the year, you know, the 5-year gilt was down at 3.3, which I said at the time was really, really low. And I couldn't understand how it was trading so low. And now this week, it's closed the week about 3.74, but the swap has closed the week at 3.70, which obviously is a discount rather than a premium for using a swap. And it is as simple as what supply and demand is there over the counter. So this all feeds, and it's almost like I'll give you the fiver later safe, because this feeds beautifully into the segue that I've done in the supplement. For those, I'm going to ask Piotr in a minute whether he's read it or not as well, actually. It feeds in beautifully because I looked at he almost spat his tea out. The UK finance data for mortgages I've also talked about, because there's a really significant low. I think it's a nearly 14-year low in the percentage of mortgages that were originated in Q3 that were buy-to-let mortgages. So that might be understandable, really, because if you think about what Q3 looked like, the 5-year gilt was nearly 5%, and the swap was up at 5.25 at certain points. So there was that premium you were talking about. And in comparison, around Christmas time or around about then, the gilt was about 3.3, but the swap was about 3.55. So whilst the gilt is nearly 0.5% higher than Christmas week today, the swap is only about 0.15% higher. And the swap is, of course, the price that the lenders pay, or it's the basis for the price the lenders pay for the money that they fix, which they tend to, not all lenders. There's a couple of small package lenders who do it slightly differently. They go into the market when they're going to complete the loan. Their business model's a bit rockier, to be honest, but they win as much as they lose, I dare say. So if they're philosophical about that, that's not too bad. But most of them will fix a slab of money, so £100 million, £250 million, something like that, and they'll have that secured. And then the job of the product team and the sales team is to get it out the door. So the 0.15% extra margin is not a big deal for the lenders, but I still think that the rates that are out there at the moment around the low fives look like exceptional value, and anyone hanging around for lower rates is playing a fool's game as we speak today, apart from anything else. So the reason for the difference is as simple as supply and demand. And the reality of that mortgage data is it's showing us that there just hasn't been a lot of demand, and therefore there's more people who want to swap on the floating side at the moment than there are on the fixed side. So could that simply be some of the very big banks saying, look, we've got a lot of money, we can access at variable rates, We don't mind doing it on a fixed basis. So we're at the table. So let's put it this way. Precise mortgages, foundation home loans, people like that, not necessarily precise because OSB have got deposit money, not a great example, but smaller package lenders are there saying, well, do you know what? We don't really need to take on much money at the moment because we're not getting a lot out the door. Whereas HSBC, Citibank, Merrill's, whoever are sitting there going, we've got some tranches of 250 million we'd love to allocate, and actually we can afford to take a bit less than we were taking. And perhaps it's also symptomatic of the fact that the sector is seen as less risky and less volatile than it was when the swap rates and the gilts weren't really under control. Whereas now feels like I've said this year, I expect us to trade in this sort of 3.5% to 4% range, with that range sort of trending down very slowly as the year goes on. Now, of course, that changes if something significant changes in the world of inflation, geopolitics, etc., etc. But I mean something really significant, not a small skirmish or whatever. A big change to the oil price or something inflationary would be a good example of that.
But talking about that geopolitical risk at the minute, and obviously we've seen lots of things happening in the last couple of days, even today, to be honest with you. Do you think that's baked in to the potential inflationary pressure and the potential reduction of how much people think the base rate's actually going to reduce by? Because I don't think that's actually baked in currently. It doesn't look like it anyway.
So this is another fabulous question. You really are. The hits are running this morning. This is super. So
I'll be honest with you though. I didn't read the supplement, but I did read the last paragraph, which thanked me for reading it. So
wow,
that is like the reverse of delayed This is gratification not deserved. This does not compute, Safe. This does not compute. I don't know where to go with that. So one of the things I almost put in this week, but it didn't make the cut actually, was just a bit of a reminder. I heard Kenneth Rogoff, who's a very famous economist, American economist, being interviewed because it's been Davos this week in the World Economic Forum, and there's lots of chat that's moved markets around and stuff like that. But one of the things that you always have to remember is that when you're looking at the interest rate predictions, right, that market is not necessarily as it appears. So there are, and we said this last year, there was maybe 10% of traders betting on a really substantial interest rate cut because of the sort of significant event you're talking about. So it tends to manifest itself in the forward curve because of hedging and arbitrage and things like that, so that we come out with headlines like there's going to be 6 rate cuts this year. But actually what you might be doing is saying George Soros or equivalent thereof is actually got some significant bets on there being 26 rate cuts this year because something really significant will happen. So the geopolitical uncertainty is a little bit baked in some of that. You know, if you listen to Andrew Bailey, he'd tell you that this is Table Mountain and we've plateaued at 5.25 and we're staying there for ages. And I do think that if you spoke to the Monetary Policy Committee right now, that is what they'd say. They're going to try, if they were being as honest as they could be. And of course, the MPC have to be very careful about what they say, so we can't be too unfair to them. But they would try and hold that rate for nearly as long as they can, to an extent, before they move it. Now, there's a lot of fuss about this because if you look back at hiking cycles of the past, that doesn't happen. They get up to this terminal rate, this peak rate, and then it comes right back down again really quite quickly sometimes. Not always, but quite often. There's three examples of that over the last sort of 40-year period, which is another reason why, apart from anything else, particularly the Federal Reserve, but also the Bank of England, are keen not to establish the terminal rate, as we would call it, what's the end of the hiking cycle, too quickly. Because when we get to definite terminal rate, some of the bigger actors in the economy will change their behavior. So at the moment, there still hasn't been that guarantee, as I've talked about a few times, of the MPC not putting the rate up anymore. And that would be a hell of a shock to the system. If the rate now went up in the UK or the US, my goodness me, you'd see the stock market take a bit of a turn for the worse, because that's definitely, so when you talk about what it's baked into, Safe, is it baked into the stock market? I don't think it accurately is. I think they're they're saying they've won before they've won, and that's just crackers, really. But there's no reason not to be bullish, so they think, because they're convinced these rate cuts are coming, and the first one will be like a cascade. But if you followed the Bitcoin price over this recent ETF saga, again, that has just baked in that, billions are going to flow in because of these ETFs. But it's already taken the money. It's already taken the upside of all of that.
It's buy rumors, tell the news, right? That's the key. Yeah, that's where everyone's like, oh, but why has it not gone up? The ETF just been approved. And it's like, well, people have already bought the rumors a long time ago and have already sold on the news as well.
One of the best business case studies I've ever read is the case of Facebook when it did its IPO, because that was a really, really good example of the retail traders getting stuck into something. And people bought Facebook or subscribed to the IPO, the initial public offering, when they went public. They subscribed because they knew Facebook and they liked Facebook. They liked the product. That's what got the retail money in there. Now, at the time, it was terrible value when it IPO'd, and it really struggled. And it was only then because at the time, they really weren't the money printing machine that Meta is today by any stretch of the imagination. But luckily for everybody, they did turn themselves into this money printing machine, which isn't that surprising given that Google were already there, and they, Facebook, you see more and more, the more I see Facebook these days, the more I see of the algorithm and how it works, the more it's only rewarding people who are paying for content to a large extent. Although, of course, things still do go viral, but so much stuff is lost in the weeds these days. I'm starting to put a lot less effort into even bothering to share stuff on there, because unless you're paying, you're not getting the audience. And that's effectively Google's way because of SEO and pay-per-click and stuff that you understand better than I do. But that's very much the way. And you're quite right. They've taken these. So do the markets look a bit complacent at the moment on the back of all of that conversation? Yes, I think they do. But if you are a short seller or a high volatility trader, someone who makes money at significant events, now probably isn't a bad time to be betting on significant events. And then you've got some slightly more guaranteed events in terms of timelines and volatility. So at the moment, it's looking seriously likely it's Trump versus Biden. But if one of them is dropping out, it's probably Biden. I think we can probably say. Now, remember that with the US election, we know what the dates are, and we know what a lot of Trump's chat is already. He's going to want to stop funding Ukraine, or he's going to want Europe to start funding Ukraine a lot more than they already have, right? We're going to have a really, they often say first term, people don't do what they really want to do necessarily. They've got an eye on the second term. Second term, they really don't give a you-know-what. And I can't imagine Trump when he really doesn't give a fish, because he's really going to be quite a force. Now, it's not a banker, because you can probably stand Newsom up against him. You can probably stand Michelle Obama up against him. There's potentially others as well that won't necessarily get beaten. But the big problem, or one of the big problems, is Harris is not popular. And as Harris is the natural successor to Biden, Biden really is looking too old for everybody, if anybody's not following it. But this is significant volatility down the line, whereas we've got uncertainty on the date. Then we've got uncertainty onto who is the most boring technocratic candidate. Then we've got uncertainty of what are they actually going to do, because the manifestos aren't really, and the Labour vision isn't really that clear. And the Conservative vision is basically anything that keeps them in the office at the moment, which just isn't really going to work. But those are guaranteed volatility events that are coming later this year, aren't they? One of which you know the date of, one of which you don't know the date of.
So what are you saying? If we are volatility traders, we should be short in the market?
Well, maybe not now, but certainly later. If it stays, in terms of how do you, for people who don't know, when you think about measuring volatility, it's an interesting concept, because you can obviously measure it going backwards in terms of how much movement has there been in markets. And you can measure it on an intraday, intra-second basis if you want to, right? But you also use indicators such as the VIX, the volatility index, and there are various versions of the VIX for some of the UK markets. So they call it the fear factor for a reason. When the fear factor is high, the VIX goes up. The VIX has been trading very, very low, especially raising some of the geopolitical risks, which at the moment are small, but that's how big problems usually have a lead in. I mean, if you remember Ukraine, if we spoke about Ukraine, the troops were on the border for, 3 weeks or something, were they, if memory serves correctly? So you kind of had a bit of and it was kind of nah, he's not going to do this, he's posturing. Oh, he's done it. He's done it because Putin doesn't really posture for that long. He was simply moving his chess pieces around and then got on with it. So you do tend to get, if you talked about the financial equivalent in our world, the 2008 crisis, it wasn't without warning and lead-in and all the rest of it. There was plenty of chatter about problems in 2007 and evidence of problems in 2007, but it didn't really start to fall apart until, the winter of 07, early 08. And then you had...
That's what surprises me is the lead time. When it's almost like you can see something, but the market's not reacting. But then when it does happen, the market reacts so sharply, so quickly that it's almost instantaneous. But you do have that lead up to it, don't you? Which you can kind of see.
I think so.
Right now there's like big expectation in the stock market to actually go up in this year. For like from my conversations just with people around, like that this is what the expectation is, and the same in property auctions. When we kind of speak to people, there's so much more positivity right now, even though nothing really has changed massively, and there's still a big potential for things to go up or things to go down. So, but the general mood is more positivity.
It's all about expectations, though, isn't it? A large part of the stock market is tech and basically industries where they need low interest rate environments to grow, right? They're all growth stocks, as they say. And obviously that's where the UK isn't as heavy on it. The UK is very heavy on value as opposed to growth, probably. The US is very, very heavy tech. You've seen Nvidia and all the rest of it. And I think it's just the expectation that the rate cuts are going to start. And again, it's kind of like that is where things start to move, not when the rate cuts, which is what the retail money is expecting, for example. It's when the rate cuts, it's too late, it's over. It's already been baked in 6 months ago, probably. Yeah. So, I think that's kind of crucial and critical to people's mood at the minute, really. And it's a new year as well, 2024, etc. It's 4 years since COVID now. Bloody hell, yeah, it's 4 years since COVID. It feels like a lifetime, but there we go.
And again, it's a really, really good point because, your world-class central banking would involve predicting forward for that 6 to 24 month period that it takes for a rate cut to take effect. But the reality is at the moment, they are sitting there waiting for everything to have lined up before they do anything. And that's not as skillful. Now, I don't know why there is this kind of absolute need to either be raising or dropping rates. And obviously, I'm saying this on the back of a period where we had a base rate that didn't really move for 11 years, right? But the general conventional wisdom is that it's either a hiking cycle or in an easing cycle, right? Why do that? Why not try 0.25%, see how everything happens, see what comes together? I think you could criticize probably what happened with Mark Carney. And I'm a big fan of Carney, as I've said many times before. But I think what's been proven over the recent times is that rates could have started going up in sort of 2014, 2015, a little bit. You said 0.25%, and we're going to see where we are. We're going to do 0.25%, and then we're going to hold for the next 3 meetings. I wouldn't have seen a particular problem with that myself. But for whatever reason, the economics, the macro of why that it's done that way is beyond me. And I think, if I'm honest, it's done that way because no one's ever tried to do it a different way. And of course, when you've got now you would hope that when you're the governor of the Bank of England, you've been appointed for 5, 6, 8 years. You have got that. There's a bit less weakness than the typical political process, because obviously we had a point in the UK where when you were appointed prime minister, you were there for a month and a half or whatever. So, you're much safer as the governor of the Bank of England. You're probably doing it near the end of your career. Not the case for Carney, but of course he had an international career and an incredible pedigree. Bailey, slightly different kettle of fish. I really hope it is the end of his career for multiple reasons when he's at the bank, but he's at the bank till 2028 anyway. So we're stuffed unless there's a trust style debagging, which you'd think if that was going to happen, it would have happened by now. And I'm pretty sure we'll use the turnip or the swede rather than the lettuce. But that's just an eponymous attempt at commenting on Andrew Bailey's appearance, which is slightly ad hominem and very unprofessional. So I'll move away from that as quickly as possible. So what happened on the? Tell us about the auction hunters this week, guys, which I did watch, but now I feel like I shouldn't, given that you don't read the supplement. So tell us about the auction hunters.
1 week I don't wake up and have read it with my cup of tea. Wow, shocking behaviour.
No, there's been some great videos on the channel so far, though, guys. Been enjoying, honestly, great stuff. So
Jay, it's the 1 week that makes you lose the habit. That's that 1 week.
See, now that's a very fickle mindset, Mr. Dursey. No, persistence. We must maintain standards. 1 week is no excuse. Otherwise, I'd be £7 heavier after Christmas.
Shall we tell Adam about an interesting one? Not to give too much away, Adam, but basically we are looking, and this is probably very interesting, specifically because we've been discussing things like gilts and interest rates and long-term bonds, maybe even. But we've been looking at some council, basically for properties for sale through the council. So Thurrock Council, which I think we've discussed as that being that BBC Panorama about as well. But where they've got a very, very long lease on it. So a 19-year lease at pretty much, you can even call it peppercorn ground rent, but really it's about £200-300. But then there's huge development value there when that lease comes to an end. But the lease is to, I think it's to Her Majesty's basically estate or Royal Mail, whatever it is. So it's clearly someone that's going to pay and not basically going to default on £235 a year, basically. So you don't really have any option, but basically to see the 19 years through. But we're discussing the potential uplift in value after 19 years and what you could then do with your money within that 19-year period versus if you were basically going to park your money in that and then get that huge uplift in 19 years' time. I don't know what your thoughts are, but yeah, we had some interesting differences and everyone kind of had a different opinion about things, really. So
yeah, I think that's a lovely point, and I think that would for me would slot into a portfolio. I like to kind of visualize things as a timeline. So at a simple level, if you've got trading businesses, then in the now they're providing you with money, they're providing you with walking around money. If there's an excess of that, you might be investing that, and that's great. On the complete other side of the fence, if you're in the investment game, you're trying not to spend any of that money now because you're trying to invest it all and reinvest it. And it's quite easy within the limited company structure, if you're buying the right sort of stuff, to back your corporation tax away quite legitimately by doing a lot of refurbishment, for example. And if you're borrowing, nearly 100% of the money because you're using bridging and you may be using investor finance and stuff like that, also you might be running up quite big bills if you're paying debt interest in the now. So that will all reduce or eliminate completely a corporation tax bill, which means money not flowing out of the system to HMRC, which means everything that stays can be reinvested. And so that would fit into a pipeline for me of it's, in the nicest possible way, people of a certain age aren't going to be interested in what happens in 19 years' time. But if that fits in with a nice lock it away investment and you did the numbers on it and you do them, most discounted cash flow models, being honest, don't really bother too much after about 10 or 15 years in the future because the discount rate gets so big. So you would need to think about, are you a J style, don't really like leveraged character, in which case your discount rate doesn't have to be massively aggressive? Or are you someone who's borrowing from Peter, Paul, and anybody else beginning with P or any other word for that matter, paying them 20% a year left, right, and centre? And if you are, then if your discount rate is 20% a year, does it really matter what happens in 19 years' time? So a really nice point and a nice, if you think the way some developers think, let's say, would be, this is the baked beans on toast mindset, right? I've just done a development, I've made £500,000, jolly good, everybody's happy, I've bought the Lambo, and I'm going to spend the rest of the money on this site, and then it'll come to fruition in 19 years' time, and then it'll be baked beans on toast until my next job is finished in 18 months or 2 years' time or whatever. Does it fit and does it make sense? And that's the beauty of the investment game in general, isn't it? What works for me doesn't work for you necessarily. There is an intersection of our Venn diagrams, but you'll do stuff that I won't, I'll do stuff that you won't. And that goes for traders, developers, investors, and the likes. And I think where you want edge, don't you? And you get edge by pricing something better than somebody else. That's the reality of it. So is there a reason in Thurrock where there's going to be, within the next 20 years, a major redevelopment of the land all around this? Is that on the cards? And are other people not pricing that in? That's the sort of thing that I would be looking at. You quite often, it's a bit like people get surprised when a local authority announces a big scheme, whether that's a big resi scheme, and again, I use these words in relative terms, not in absolute terms. So in Solihull, a scheme for 1,000 houses in near the town centre is a really significant scheme, right? It's not going to be significant in the council of Birmingham. It's going to be a pebble in the pond, right? But in Solihull, that's significant. So when a scheme, which this is a scheme that was announced relatively recently, but it was rubber stamped. They started talking about this scheme in 2010, right? So it was coming. It was always a matter of when, not if. So you knew it was coming. Now, if you've got that 20-year time horizon, you can be pretty sure anything that's being talked about now might well go through with a probability of success. I love these sorts of problems because they're very mathematical, or you can make them very mathematical, which leads you to a right or wrong answer, potentially. But it still could be right for me and wrong for you, or vice versa, because of our ages, discount rates, risk appetites, alternative uses of capital, and all of those things. But it's a great question.
One of the questions we asked ourselves when we were filming this one specifically was, if you're a land banker or a small to medium sized developer where you hold sites for a period of time, one of the bigger issues you have with holding sites over a period of time is fly tipping, people using a corner of your site for 10 years uninterrupted, and then you have boundary disputes. If it's commercial property, people just not break. Oh, someone left the window open. All of a sudden, you've got a team of squatters that have been there for 15 years. Like, all of these different types of things are problematic. But with a site like this, it is occupied. Granted, you're not really seeing any real meaningful return on that occupation, but there's less likely that someone's going to squat it. Less likely that you're going to get boundary disputes or fly tipping or whatever else. And then we came up with, what is the price that you would be happy with holding this? Almost like your pension, right? Because let's say you start working at the age of 19, you don't retire till you're 65. That's many more years than 19 years where you're having money go out into a pension that you're not receiving a return on. So in that respect, I thought, well, if you had £100,000 today, and you said to yourself, let me just take this £100,000. It's cash. It's sitting there. There's no real cost to it apart from opportunity cost. Let me just bank that away over here and forget it exists for the next 20 years. Or actually, if it's 19 years, you can forget about it for 17 years, pick it back up and go, right, I've got 2 years left on this lease. With those 2 years, I'm going to talk to planning. I'm going to talk to an architect. I'm going to talk to a developer. I'm going to do whatever I need to do. Because surrounding this site is residential already. The site is bigger than the neighbouring sites. So the opportunity is really very clear. But you have risks over a 20-year period of time. Sometimes holding something for that length of time in a linear space isn't the best thing to do. Because you don't know if they're going to put protections on commercial assets surrounding residential. So maybe you'll go, well, I can still do a residential development if I keep the ground floor commercial. There's different ways to look at things. It could be any number of reasons that they decide that they don't want that developed out to residential, which in 20 years' time I don't see as something that's reasonable. But you kind of have to factor stuff like that in. So
you do.
Yeah. So for 250 quid a year, how much would you hold for? I said £100,000 because the land value at the end of this lease with planning could be £5 to £6 million. Do you know what I mean?
I think we're slowly spoiling the episode.
We
slowly
are
releasing too much details, Jay. Too much
okay,
details.
I'll stop.
I think that was Adam's point for us not reading the supplement. I don't know if you've noticed or realised, but it's been slowly just reading out.
Adam's like, I'm going to trash their channel. I'll get Jay talking. That's what will happen. That's what we'll do.
Revenge
on a
is
serious
mine.
note, though,
Revenge is mine. Yeah.
On a serious note, though, Jay, it kind of raises the question of regulated tenancy, freehold ground rents as well. Yeah, this is all very similar stuff. Obviously, now we're seeing with freehold ground rents, it's coming with a lot more regulation. So I actually own freehold ground rents myself. You've now got things like freeholder certificates you have to sort out, and potentially you're taking on the risk from the previous developer or owner, whatever, even for things like, even though it's not cladding, it's compartmentalizing internally fire doors, electric meters, etc. All of this kind of stuff. You're then, as a freeholder, having to take that cost on for the flats that are what we call qualifying leases. And for anyone that's interested in that, you need to either be an owner occupier or own less than 3 houses. I think it's February 22 off the top of my head at that point, and then you become a qualifying leaseholder. And then there's a whole host of things that you have to calculate in terms of the value of the property, of the flat at the time, whatever. But my point is that's coming with more regulation. So it's all of a sudden the people that own the freehold ground rent now have more operational cost, operational time and effort, operational risk that they have to start thinking about before they start realizing their premiums. And then on the flip side, we've talked about this, like the Mount Views, the Grangers, I know a lot of cash buyers as well, that will buy the regulated tenancies at 50 pence in the pound, maybe without even any rent at all, or maybe, I think that's Adam stroking our egos there.
That's the quality bit of thumbing there. That's that technique.
That was me reading the comments, actually. But yeah, I prefer stroking the egos. That's good.
You can tell he's a happily married man with that technique. That was smooth. That was the tempo and everything. I got a little bit sidetracked for a second.
Only for you, baby. Only for you.
But my point is, some people will buy a property with no rent, but because they're buying it at such a cheap discount that there's such a big future value plus equity from day one when that tenant potentially passes away. And then they start to do calculations of, well, how long is that tenant potentially going to be living for? Do they smoke? All of these factors that you've got to start looking at. So I think these kinds of investments are more for armchair investors, bigger institutional investors that really have a low cost of capital, not a 20% from PPP, as Adam has said. But really, people that have the time and effort, people like us, we can get way better returns by putting the time and effort in. But there's nothing wrong with maybe putting a small portion, if you have an extra amount of money that you don't need, you can allocate towards that. That's kind of my thought process.
I think that's absolutely bang on. I do think that's bang on, because you can add so much. I've always operated my business on cycles, right? How many cycles can we get through in 5 years? In the good old days, it was about 7 or 8 cycles, because we would buy, refinance after 6, valuations after 6. So it's maybe 8 months, 9 months tops. And so you get those cycles in over a 5-year period. COVID kicked that right out. So it was more than 12 months at one stage for us to go through a cycle, which really hurt our IRR, but it was really difficult to do anything about it, really. It was take your medicine time and let's see how robust your business model is to an extent, because just people misunderstand the value of time in property development and investment. Is probably the biggest mistake that people make. And I led a thankless charge on my own that was unsuccessful. Not long after I came into the property arena to try and explain to people what options really were in the Black-Scholes pricing model and the interest rate risk they were taking on board. And precisely 0 people listened to me. And it became relatively pointless because the interest rate didn't move for 10 years. But people didn't understand how lucky they were, right? They didn't understand. And people forget that sometimes just because something happened doesn't mean it was always going to happen. It was an event that had a probability attached to it. And it might have been quite likely to happen, but it absolutely wasn't guaranteed to happen. So that is the most difficult thing to explain to anyone. And that's something I've taken away in terms of from previous careers / entrepreneurial ventures and activities.
So in a former life, I used to manage a part of a private family trust, and the global net of that trust was in quite a few healthy billions. It was huge. The money and the assets were over 300 years old at that point. And one of the things when you're dealing with stuff at that kind of level is that there are no cycles. The cycles don't exist. The LTV in the UK and Europe for their asset backed, so for real estate, was 17%. And when you command such a chunk of a marketplace globally in terms of wealth, you're not really priced the same way that other people are priced in terms of risk to debt. So the banks, the funding streams, all that stuff applies to you, but it applies to you. But you're made to feel very special about it. You're not. So in the current state of affairs, if they were refinancing a couple of thousand units in the UK, they will not be held to the same affordability checks, for instance. That the affordability checks doesn't actually apply if you have X number of billions of pounds. So the cycles are different. How you keep the machine fed is really important. How you optimize and continue to optimize, because if you think over a 15-year period, there's only so much optimization you can do in a fixed portfolio. You take that over 300 years, then that becomes a bigger issue. You then find there are different concerns and issues. There isn't really a cycle, but X number of tenants or tenant type or asset type becoming fragile, and you have to move. It's like steering the Titanic away from an iceberg. You have to move away, and it's never quick enough. So although they're not judged in the same way and they're not priced at the same way, the risks are still there, and that tends to be seasonal. So they don't really think about cycles in terms of a 15-year cycle or a 7-year cycle. They tend to think about it in seasons. And they're actually quite nimble in how they operate in that respect. But that's very much a past life.
There's a very big investment. Actually, sorry, I think it's a trading platform. I think it might be Fidelity, and they did a study based on who got the best returns. And I think it was kind of showcasing that people that had died or forgot their password, but people that had died basically had the best returns because they weren't then bringing emotional, looking at the stock market, buying, selling, doing all this, that, and the other. But people that had died made the best returns, and people that died and forgot about their accounts. I mean, and then the next best one was the people that forgot their passwords, because a lot of this is based on emotion. So we are emotional people. We'll, look at the news. We'll speak to our friends. We'll speak to other investors. We'll read things, and then we'll kind of make decisions based on that. And I kind of say this from a point of view of, because obviously, if you have the luxury that you have your day-to-day trading income that puts food on your table, feeds you every single day, that can be great where you can set and forget, so you can buy assets, riskier assets, whatever you want to buy, and literally do it from a point of view of, I don't need that money for the next 20, 30, 40, 50 years. And you put that way, and maybe your children or your children's children, whatever, will then thank you for it. But I think it's really, really crucial that from an investment point of view, not from a trading income, but just purely from an investment point of view, people need to have the longest term mindset possible. Because if you're looking at things from a short term perspective, you start selling an asset because a boiler's broken or a roof's gone or whatever it is, you're then basically really just creating potential loss, which could have been blended in over a very long period of time and a very healthy profit from capital appreciation, from rental figures, etc. So it's interesting that you kind of said they had a 300-year time frame, which takes cycles completely out of the whole equation. So that was really interesting.
Brilliant.
Adam's opened up the floor to everyone else to speak. Oh no, he's back.
Yeah. We've got a couple of questions from people who are watching. Sunil is asking, what is everyone's thoughts on external insulation? I'm having that done soon. Anything I need to be aware of? Any comments, guys? I'm not big.
My personal opinion is, so obviously we had the whole EPC regulation come in, get kicked down the road to 2028 from 2025. Now potentially not even required, might be coming in again if Labour come. We really don't know. What we did when this got announced was we literally took a whole list of all of our portfolio. We basically cross-referenced all our EPCs to figure out where things were. We had some already at Bs and Cs, which is great. We had a lot of Ds and Es, and I think we had 1 or 2 Fs because they were electric funny enough, which is ironic. In my opinion, I think unless you're going to do it because you have a reason to do it, not just because of the EPC regulation, then that's fine. But if you're doing this just because of EPC regulation, I would personally sit tight and just wait, because the reality is you're spending an actual external wall insulation is quite costly. It's not cheap. You're looking at a couple of £1,000, which could be quite a significant amount of the property value or the rental income. So from my opinion, unless there's a specific reason to do it, I personally would kind of just wait. That's just my opinion.
Yeah, looks like Sunil is doing this anyway, probably. But I'm not big into insulation or EPC matters, so I'm not really qualified to say. Jay, you have any comments? You always have comments about something.
Yeah, I think my comment is just more of a practical one. You know, the fascias on these high-rise buildings, they've been ripping off because it's a material that is flammable, it's a material that's X, Y, and Z. You just need to be very, very thorough in investigating what materials you're putting on the outside of your building, what the risks are, and making sure you're picking the correct materials, because what you don't want is externally cladding your building for in 5 years' time, that cladding to be something that jeopardizes the mortgageability of your property. So, you know, because there were people that, 10 years ago were spray foaming their roofs. You know, you can't mortgage those now. You have to rip a roof off and stick a new one on. So Safe's point about being temperate, just waiting, seeing, investigating, that kind of thing, I'm a big fan of that, but have no commentary on which one is best or otherwise.
Great. Another comment and question from Dominic. What are your thoughts on a land option for a quid and 50-50 JV with landowner on planning gain and then sell, develop?
Dominic, you should be ashamed of yourself. We sat in the same room listening the master that is Paul Higgs discussing this on Thursday for about 5 hours. So how you still have questions about this is absolute insanity. It works. It works. You just have to be a Paul Higgs level of character, or probably someone that he's trained over years to pull this kind of stuff off, or just a land buyer for Barrett's, Linden, Red Row, whoever, right? But have you've looked at something like this in the past, haven't you, Safe? Or it was
yeah, so my opinion is very much, I look at it from a business point of view, and from my perspective, if you're doing this day to day and that's your main business model, you've got these, you've looked at so many of these agreements, your solicitors are well versed in them, you've got the whole setup for them, absolutely go out and do them. If this is part of what you do, or just a tool in your toolbox, it ends up taking a lot of your time, effort, because don't forget, there's going to be a hell of a lot of expectation management with that landowner. You need to be double checking their potential finances. You really need to be looking at them as a potential partner, right? So this is not just a case of, oh, well, they're just chucking the land into the JV partnership and we're kind of getting the planning and development. No, you need to actually be on top of every single thing. You need to be constantly communicating. To me, unless you're doing this as your main business model, like Paul Higgs, like other land bankers, and yeah, some people do this extremely successfully. There's so much money to be made in it. I would not be doing it as a side hustle personally, right? Because I'm a firm believer in just focus on a kind of niche. Because once you focus on that niche, you've got your setup, your legals, your power team, your contracts, everything in that niche. You've then got your experience, and that creates a circle of competence. So do I think it's possible? Absolutely. Do I think it's profitable? Absolutely. But then the individual circumstance for Dominic, for example, with everything else he's got going on, might then take his focus away from other things. So I can't comment on everyone's individual reasoning for it, but that's just how I look at things personally from a high-level business point of view.
I mean, if you scrape back the shiny penny, because it sounds amazing, it looks amazing, you take into consideration Safe's points, and probably bigged him up a bit too much, but Paul Higgs is as a paragon of someone that we know that does this kind of stuff, right? Paul understands the risks. When he's putting money into one of these, you think, oh, it's a £1 deal. It's not a £1 deal. It's a £1 deal plus the risk of planning costs, which could be, and he's got a good track record. He gets the planning, even if it's on appeal. Then you have the build out costs. So whilst you're not paying for the land, and that sounds amazing, the flip side to that is you don't own the land.
Not only that, Jay, don't forget, Paul comes from a background of working for the actual kind of biggest developers in the UK. That is experience you will not get apart from working for them. So he's coming from a point of view of extreme broad experience, anything to do with land developments, etc. So it's just a totally different mind. He's seen the systems, he's seen the processes, he's seen every single problem, and obviously everything that went right, and that's what he brings to the table as well. So although I think it does look great, I don't think it's necessarily for everyone as well, because you will have a lot of grey hairs doing that. But when it works really well and when it's profitable, it's extremely profitable and it works extremely well. And that's why people ask me, yes, I did a land deal, right? And yes, that's what we kind of got the trade of the year for. But is that something I do on a day-to-day? No. So I've narrowed down my criteria. I don't do commercial. I don't do land. And if something comes across my desk, I might look at it if our deal flow is lower than usual. But generally, I've got such a tight criteria. I might be chucking away loads of great opportunities, but that's just because I want to work with speed and quicker by doing volume. And that means having a very, very specific niche of what I'm looking for. Freehold houses, under 300K, not in Scotland, not in Wales, just England only. That's kind of what I work towards in terms of my practice.
But that's another good thing about what you do is like exactly what you invest your own time in. But then when you have good leads for commercial property, then you know also how to utilize it with working with other people. Like we did a couple of deals together where it's like we made those leads like basically bring some results rather than just checking them away. So I think you've got quite a good system of filtering what's right for you and what's also right for others and how to monetize those opportunities.
Absolutely.
It is a good thing. Brilliant. Well, I think that really nicely concludes our chat for today. Thanks for stepping in for
Thanks for having me on, guys.
Dave.
Enjoyed this one.
And hopefully we didn't spoil the Property Auction Hunters episode coming up tomorrow too much, and people are still gonna watch it. It's the Property Auction Hunters channel on YouTube. We release a video every Monday at 7 p.m. So tune in and you can watch the previous 7 videos we released on the channel. And what else? What else should we wrap up with, Jay? That's it.
Me on the spot, isn't it? I think that's it.
Yes.
Yeah. I think I think we'll finish on the point that Safe made is, you look at someone like Paul and his history. This is his skill set. He's almost a complete unique anomaly within the marketplace. You look at maybe a little bit of an ego pump, but you look at someone like me. I've worked for a high performance London auctioneer, then a national auction company. But Safe is right. I mean, I don't know. There's other examples, of course, that just kind of put me on the spot. But you have a skill set, you have a knowledge base, and sometimes you need to clear out the noise and the mess of what everyone else is going on, whatever else is happening, and just have faith in the fact that you know what you're doing. You come from an area of expertise, you have a skill set, and focus on that. And
one thing on that as well.
Yeah.
The worst deals I've ever done is the deals outside of my circle of competence. Honestly, I track every single deal that I've either broken even on or made a loss on or whatever. And there's not loads of them, to be fair, but the ones that I did, it's completely outside my circle of competence. And those ones then make me say, we're not buying stuff like this again. Basically, that kind of just tightens your criteria. So yeah, I totally agree with your points. 100%.
Amazing, guys. Everyone, have a great Sunday and stay within your circle of competence, and see you next week.
See you next week.